For generations, Indians did not invest. They saved, and they saved in the same three things: gold in the locker, land if you could afford it, and a fixed deposit at the bank. It made sense. You could hold gold. You could stand on land. The stock market felt like a casino for other people. And that belief held for decades. Even today, gold and property are still more than 60% of what Indian households own. But underneath that, something remarkable has been happening, quietly, almost invisibly. In March 2017, an industry body called AMFI launched a campaign with 4 simple words: Mutual Funds Sahi Hai. It ran on television, on radio, in cinemas. Sachin Tendulkar and MS Dhoni lent it their faces. It didn't promise riches. It did something smarter. It made investing feel normal. Within a year, roughly 50 lakh new investors had entered mutual funds. The industry's assets jumped by a third. For the first time, a middle-class Indian family could say the words mutual fund without flinching. Then the second thing happened. Investing moved out of broker offices and onto the smartphone. Apps like Zerodha, Groww and Upstox stripped it down. Zero commission, clean screens, digital verification in minutes. Suddenly you didn't need a broker, a fortune, or a suit. You needed a phone and 500 rupees. The gate that had kept ordinary Indians out of the market for 80 years simply stopped existing. In 2020, India had around 4 crore Demat accounts. Today, there are over 21 crore. That's not a trend, that's a flood, and look at who is opening them. In 2019, investors under 30 were 22% of the market. By 2026, they were 38%. Roughly 3 out of 4 new accounts in 2025 belonged to someone under 30 years old. Women investors climbed too, from 22% to nearly 25%. Still low, still rising. India wasn't just investing. India was getting younger and broader about it. But the real revolution wasn't the accounts. It was one small, boring instruction. The SIP, a fixed amount leaving your account every single month automatically. Not a bet, not a trade, a habit running quietly in the background of millions of lives. Today, India has 9 crore 72 lakh active SIP accounts. Every month, they pour in over 31,000 crore rupees. Every single month. Those SIPs now hold nearly 15 lakh crore rupees, built almost entirely out of small amounts. And then, in 2026, that quiet habit did something extraordinary. In the first half of 2026, foreign investors decided to leave. They pulled out 2.7 lakh crore rupees. This is the moment India's market always broke. In 2013, and again in 2018, selling like this crushed it. 20 to 25% gone. Everyone braced for the crash, and it never came. Because as the foreigners sold, Indians kept buying, automatically, on the same day of every month without being asked. Domestic investors absorbed every single rupee the foreigners sold, and then bought 4.16 lakh crore more on top. The Nifty fell about 5%, not 25%. The crash was caught, and it was caught by ordinary people's SIPs. And in that same quarter, something happened for the first time in India's history. Indians now own more of India's market than foreigners do. So what does this teach us? Lesson 1. Consistency beats size. That 31,000 crore isn't big checks, it's millions of small ones. Lesson 2. Automatic beats emotional. The SIP investors didn't outsmart the professionals. They simply didn't stop. Lesson 3. Your small SIP is never too small to matter. Together, it is now the steadiest force in the Indian market. And here's the best part. Gold and property are still 60% of India's savings. This story is just getting started. You're not late. You're early. If this helped, like and subscribe for more finance and investing tips.